Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Andrew Padoa from Sasfin Wealth and Thamsanqa Netha from Shiloh Capital. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. What's been very interesting and something that stood out for me when I opened SENS is the retailers that have actually been riding the green wave today. You have Truworths, Woolies, Pick n Pay, also TFG. Yeah, let's actually start off with, because obviously I understand that Pick n Pay also came out with its results, but it did lose its steam along the way. But just the general sentiment on retailers, Andrew, is there anything specific that's been propping them up today?
Firstly, Zinati, thanks so much for having me. But just looking at the retailers, the answer is no. I haven't seen anything specific that's the reason for retailers up. You know, Pick n Pay's results were out this morning. You know, apart from Boxer and the Pick n Pay clothing side of things, the results weren't that great. And Pick n Pay's shares actually, I think they're now in the red as of right now, and the rest are all in the green. So I'm not entirely sure why the retailers are so strong today.
Well, tell me, actually, I mean, there's been a lot that's happening, well, I guess macroeconomically, but maybe not necessarily in real growth, but in sentiment. Do you think that's maybe, you know, what's propping up the retailers today? Or maybe the fact that the budget is actually this week?
Yeah, look, retailers are an indicator of where the economy is at. They're right at the forefront of consumer spending. There's a view that the consumer is going to have a easier time going forward. I think the view around lower interest rates potentially, and then the two-pot system, which has also released some funds. So I think there's a view that the consumer spending is going to improve going forward. And Fushini Group obviously has done the deal for the white stuff in the UK. So they're looking to perform really well, and they're looking to expand. I think they've realized that South African consumers are very price sensitive. So you need to have a broader set of markets that you're addressing outside of South Africa. So I think it's an indicator more than anything of the market view of the consumer going forward.
Yeah. Well, Andrew, you spoke about Pick n Pay, of course, still in a loss-making position. I don't think we expected really anything different from there. And of course, we were expecting an announcement about Boxer. And as much as Pick n Pay has kind of turned into the red, it's okay. Relatively flat. I don't know. Are investors looking at Pick n Pay thinking that, you know what, we've seen the worst of it at this point and we can't be expecting any more downside?
So Pick n Pay's had a lot of bad news the last 18 months or so. They did have the trading statement out the last week or two or so ago. So we knew that the results were not going to be great. This just gives us a bit more color now that we've got the full details and the actual earnings update. So the standouts for me, like I said, Boxer, that's kind of been the story for the last 18 months. As Pick n Pay's been really struggling, Boxer's done really well, and the clothing side of things have done really well. And that's kind of the same theme that we saw today. Pick n Pay's margins were down. That was one thing I picked up. The CEO, Sean Summers, did say in the results that the worst is over. He did say, this time last year when he took the job that it was going to take another year before they would turn. So he's saying that this is now the turning point, the worst is over, and Pick n Pay should be doing much better going forward. But I think it's going to be tough for them to regain lost market share. You look at, wherever I drive around, where I live in KZN, there are just Checkers 60/60s everywhere. And so, I think over the last, not just 18 months, maybe the last 3 or so years, Pick n Pay's lost a lot of market share to their peers. I think it's going to be tough for them to regain it.
Yeah, and we know those the Checkers 60/60 drivers. They go by any means necessary to reach that 60-minute mark.
Yeah, and they've got a time cap.
Tommy, I mean, it's quite interesting, to hear from Sean Summers that the worst is over. Quite interestingly, because ShopRite just keeps on, taking ground, and I'm wondering if, how do you take that statement?
Yeah, I think in reality, the business needed that. They needed to make some difficult decisions, and I think they've gone about the business of doing that. But as Andrew has said, the water has got a lot of sharks now. Woolworths has tightened its ship. Checkers is positioned itself as Woolies Light. ShopRite remains the top bargain safe plus store. So Pick n Pay has to find itself in between there somewhere and look for a value proposition. So I think their struggle is what value proposition do they bring to the market? What value are you bringing that will drive consumers to come to you? The clothing, it's obvious, quality at an affordable price. If you look at Boxer, it's competing with the macros of this world, so mass selling, it'll always attract a lot of clients. But for the normal store, it's going to now be a challenge. How are you going to draw people away from their cell phones at home and getting their things delivered in 60 minutes to coming to your store and buying? So I think the tech side of Checkers 60 is really impressive. And I think Checkers has done well with that. So we'll see. They'll have a lot to do. That Pick n Pay ASAP is not great. So they've got a lot of work to do in terms of that last mile to the customer. How do you get the consumer in South Africa coming to your store more often or ordering off your apps?
Well, a specific question there, particularly on Boxer, a discussion point around the Boxer IPO. This approach Pick n Pay is undertaking by unbundling has confused me. On one hand, I thought holding my Pick n Pay shares would be a good idea to receive free Boxer shares eventually. However, with this IPO, could the Pick n Pay share price plummet and I won't even get a Boxer in return? Pick n Pay shareholders are getting Boxer shares in return, Andrew.
Yeah, that's my understanding. Tommy, is that right?
Yes.
That's correct.
Yeah, that's what I understand.
Yeah. So, I mean, as a Pick n Pay shareholder, I mean, I guess that's been the big question is, as a Pick n Pay shareholder, do you hold and wait until you get the Boxer shares, or would you rather sell your Pick n Pay shares and go straight to Boxer? Is there an easy route here, Andrew?
I don't think so. I think maybe it also, you have to factor in the weighting of Pick n Pay in your portfolio, because my answer might be very different if you've got a weighting of 20% Pick n Pay versus a weighting of 2%. You know, if you had a weighting of 2% of Pick n Pay in your portfolio, I'd probably say to you, look, you know, just hold on. You know, it's probably a bit late to sell, and it's already fallen so far. The difference between 2 to 0 is pretty negligible compared to the pain you've already suffered the last 5 years. So I think it would come down to what your actual portfolio looks like.
Yeah, it's quite interesting because other people would say, you know, holding your Pick n Pay shares and then getting the Boxer shares, it's like you're getting Boxer shares, but then you have the Pick n Pay business for free. How do you look at this, Tammy?
Well, you've got to think about it more broadly than that. So what Pick n Pay in essence is what in essence they're saying is they want to focus on core business. So they want to give you as the shareholder a part of the business that they don't want to continue to operate and think about. So new management, new staff, it's off their books. They can focus on core business. And we've seen this before with other companies across. Transaction Capital did the same with Vukile, where businesses want to focus on core business. They offload. Naspers did it with MultiChoice. They offload these businesses which are not core to them anymore, and they give those to shareholders, and then they focus on driving the value in core business. So if you are a shareholder of Pick n Pay, I would say hold on. You'll get your Boxer shares, but what you should be aware of now is that the management is pushing to focus on ensuring that Pick n Pay drives value. And that singular focus could be to your advantage over the long term.
All right. I have a question on investment strategy here. Firstly, the viewer says, thank you for the great show. A round of applause to you guys, because I'm not the expert. It's you guys that make the show. So I understand that limiting your downside on a loser is very important to guarantee returns. However, we very rarely get advice on when to cash out on a winner. I know the panel cannot commit to a hard and fast rule here, but surely there can be some guidance. For example, a stock hits the target price they set for it, they redo the calcs and it has a similar valuation. Do you sell, say, 50% and watch for a while, selling 25% of the remainder at incremental targets of, say, 5%? Throw us some bones here, please. Andrew, yeah, when you have a winner...
Sure.
Obviously, yes. The graph never stays linear, the graph of growth. So what do you do here when you maybe just want to take some profit and timelines and also the weighting that you do it in?
I think it comes down to the company. If you are looking to ride your winners with a cyclical company like a mining company, I think I'd be a lot quicker to be trimming the positions, because I know, it's going nicely and the shares have run, but one day the shares will fall because they are very cyclical. So I think it depends on the business. If you are holding a high quality company that's got a long-term track record, dominance in their market positioning, balance sheet strong, operate in a secular tailwind, I don't know if I'd trim. Maybe I would keep running it. I'd keep riding it. So I think it just comes down to the company. But, if I look at the portfolios that I manage, the ones that have really outperformed global markets over long periods of time, it's a handful of stocks that have driven the total portfolio return. And it's because you had some quality companies and you allowed those winners to keep winning and they compounded over time. So sorry, it's a long-winded answer, but I think it depends on the company.
Yeah, okay, I hear you on that. Very, very interesting. Tammy, what's your take on that?
I largely agree. Typically, our view, especially when we speak to smaller portfolio clients, is to say once a stock reaches 50+%, you can take out your capital. Okay. And then you're now playing with house money. So if you are an individual investor and you bought a stock at R1 and it's now R1.50, take out the R1, keep the 50 in there, you preserved your capital. Now, if the 50 goes up and down, it's all house money. So that's what we typically advise. But for the larger portfolios, we pretty much follow Andrew's approach. You look at it as an 80-20 principle, that 80% of your value creation will come from 20% of your stocks. So you need to pick the right businesses over the long term, and they tend to drive and deliver value in that regard.
All right. I want to talk about Sun International because it did participate in the rally. In fact, it's probably, the biggest climber on the JSE today. Last time I checked, it was up almost 5%. Quite interestingly, this is after the Competition Commission came out with a detailed report saying that they are recommending to block the acquisition of Piedmont by Sun International. I'm wondering why the cheer in Sun International after this, because I would think that because Sun International was, gunning for this for value creation, but somehow shareholders seem quite happy. Tammy?
Yeah, I think Sam Sitole and Value Capital Partners must be very happy. Their investment seems to be emerging nicely. But I think more to speak to the point, I think the Comcom is concerned about how the industry will become controlled by two major players, which is Tsoho Sun and Sun International. And I think they state about the inland gambling houses, how they operate, and seeing them being controlled by two large businesses is concerning them. I think the deal will inevitably go through. There will be some checks that Sun International will have to go through to satisfy the Competition Commission. But I think it'll be a good portfolio add to them, and they will provide good competition to Tsoho. But there's the other angle where we haven't considered how gaming or gambling is going online. So there's a lot in that competitive space that's going to be interesting going forward. And I think they'll have a sound argument to present to Comcom. It's a 7 billion rand deal, so I think it will happen.
Yeah, of course. Yeah, that now rests on the Competition Tribunal. Andrew, do you think that it's also maybe investors thinking with or without Piedmont, Sun International is a good investment?
Yeah, it's an interesting one. I think when you see a share up like 4% when it kind of gets blocked, you maybe think that the shareholders don't think it's a good deal. I don't know. So that's kind of the pattern that I've seen historically. I'm not sure if it's the case with this one. Sun International is not a company I've been following too closely.
Yeah, it's going to be quite interesting to see what comes out of that. Of course, Sun International did say to us on Friday that they will keep us updated on the developments. There's a question on City Lodge since we are on Sun International. Your view, Tammy, on City Lodge?
So I think they've placed themselves directly in competition with Airbnb, and that's a difficult thing to do. They are now location bound. They were targeting business travel specifically, and I don't know if they can compete well with with Airbnb, because that's now their direct competition. Hotels are different, but they are saying we are a low-cost, high-value option for business travelers mainly. And I think that is not going to be a sustainable business model for the long term, especially when business travelers now have other options, Airbnb being one and hotels being other. So I think they originally had a sweet spot, but I think they've lost a lot of ground to the other competitors who have come in and are offering the same low-cost, high-value offering, but they look more snazzier. So I think they're going to have some challenges going forward. Hopefully they can be nimble enough to work through that and add value to price.
I don't know if I agree with you, Tammy, because I recently went to Durban and I picked a kind of low-cost option, but then when I got there, it looked high, and I was like, yo, I regret not going for City Lodge, because I feel like with City Lodge, you know what you are going to get. And not even necessarily for business travel, for leisure as well. Andrew, what do you make of City Lodge?
Well, Zanati, next time you're in Durban, you need to let me know so we can grab a
Definitely.
coffee. No, I agree with Tammy on all those factors. It's City Lodge isn't a stock that we've been looking at. I think it's probably Sun International's probably the one of the three that I'll be looking at in that space. That's the one that we are looking at on the bench list.
All right. Well, let's go into property. Growth Point. What's your view on Growth Point? Yeah, and it's quite interesting because the property sector has been one with a lot of investor interest lately. Yeah, Tammy, do you think that there's still more upside for counters like Growth Point?
Yeah, I think the swing is coming around, right? So post-COVID, they took a big bludgeoning and valuations changed. But now they have they've got a different challenge now. Can they fill up office space at a profitable price? And it seems like they are beginning to do so. Growth Point is showing signs of that. It looks like there are green shoots in the property sector. And that's a sector that's what you'd call a leading indicator of how the economy is set to go. If more office space, retail space, if more warehouses are being taken up, that's a sign that the economy is starting to pick up. Economic activity, rather, is starting to pick up. So yeah. I think it's a good indicator. Also speaks to their operational ability. They've managed to turn this around. This sector has had a few casualties. So the people who survived and can manage to drive value, turning them around, filling office spaces, giving good deals, which they do a lot. I think they'll continue to succeed over time.
Indeed, survival of the fittest. In this property sector, Andrew, would you be looking at Growth Point or maybe some other counters?
So within the property space, Vukile is probably one that we would be looking at, maybe top of the pops there. I think they're very well managed. You've also got your exposure to Iberia or Spain.
Yeah.
So they're almost, I think it's 50% Europe now, based in Spain. So yeah, I think Growth Points, like Tammy said, turnaround story there. It's just that interest rates are coming down, so that's obviously favorable for the property guys. The commercial property sector is just challenging at the moment. We saw with Spear's results, I think they were out last week, and Spear's purely a Western Cape play, and even they were kind of showing signs of challenges in that commercial sector space.
All right. Well, let's go into Sasol. I always say there's always a question. Every single day we have at least one question on Sasol. The viewer says, about a year ago, I wrote to your program saying Sasol was uninvestable, providing my reasons. Commentators brushed it off. I sent 2 subsequent updates to Stockwatch within about 3 months thereafter. Still, the commentators were supportive of Sasol, even choosing it as a stock picks. Now they're all shunning the share, saying they won't have it in their portfolios. Time to buy. So it seems like the viewers kind of going
do the opposite.
So it's a contrarian. So yeah, it's easy to be contrarian. What is difficult is to be contrarian and to be right. So I think when you look at a stock like Sasol, it's had its really difficult times. So you have to have a view of the industry and have a view of the management. And I think if that view is positive, you'll find a positive. And Unfortunately, stock pickers are not magicians who get it wrong. We hopefully will get it right more than wrong to the benefit of our clients. But my view on Sasol is that I think if you own it, hold. I'm not at the buy point yet. I think there has to be more evidence to show that they can operate their business units well. I think they'll get a lot of traction with the other, especially like the chemicals business. I think that business will get a lot of traction going forward. And they have to manage that, and we'll see how they do. If you own, hold. If you don't own, I think wait on the sidelines for a bit.
It's quite interesting because I feel like from what I've gotten from our viewers is that they're just looking at the price and just saying there's no way, this looks too good. And at this point, it seems like the kind of operational challenges that they're facing aren't really, and even the volatility of prices between oil and chemicals isn't really a consideration. Andrew, how would you be looking at Sasol?
I agree with Tommy. Not buying Sasol. Yeah, if I look at their returns on equity, we were just talking about riding your winners.
Yeah.
So Sasol's kind of is a very cyclical company. They're either doing really well or really badly. I think the share price from 2020 probably looks like an Egyptian pyramid. It got $20 in March of 2020, and then it shot through what I can't remember the number offhand, and then it's just now we're at 100. We're under 100 at the moment. So Sasol's a short-term trade for me, but it's not one that I am short-term trading.
Yeah, and that's the thing. I feel like a lot of people can't get over the climb, the breakneck, climb speed that it went through during COVID. So I think people are just hoping for a repeat. But yeah, we will see. Tammy, Telkom. I'd like to get your view on Telkom. Is there any chance it could improve under the new GNU if the private sector will be allowed to get involved to spark growth and drive expansion in, for example, fiber?
Yeah, look, I think Telkom has lost the race on that. They've allowed other market entrants into the space. Historically, when they had the phone booths, they could have to some degree converted those into a great network for internet, wireless, and fiber. But now with the growth of Dark Fiber Africa and its new partners, and what's happening with the data centers with Neotel, or formerly known as Neotel, it's going to be very hard. This is a business they could have entered into, the data center, the fiber. They could have, and internet across the board. They could have entered that space, but they've given up that space, and they're still trying to compete on the mobile side, and as well trying to compete on the business telephony side, which is hard because the other incumbents have taken huge leaps in that space. If you just look at Adapt IT's business and how they've taken a large chunk of that space away. So I think Telkom will have to have more innovation rather than anything else. They need to be able to say, we're going to push forward in these areas and drive this innovation in this way. Outside of that, I think there'll always be a laggard in the industry.
All right, we have run out of time, gents. Let's get to your stock picks. Andrew, what are you choosing today?
Sure, my stock pick tonight is Sasol. No, I'm kidding. It's not. It's Visa. It's Visa. So, yeah, my stock pick is Visa. There's a great Warren Buffett quote, and it says that there's no extra points for degrees of difficulty in investing. A 12% annualized return is still a 12% annualized return, whether you spend months figuring out if a turnaround's going to work, or if you just stuck to a company that's been winning for decades. A company that's quality growth, great track record, operating in an industry with secular tailwind, little competition. And for me, Visa is the poster child for that.
All right. Tell me, what are you picking today?
Meta. I think they're going to win the data race. They've got a lot of information, especially on the populations of people. And I think they're stocking up the processing computing power to be able to analyze that data and provide meaningful insights to both companies and individuals. So Meta is my stock pick.
All right. Thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guests, Andrew Padoa from Sasfin Wealth and Thamsanqa Netha from Shiloh Capital. Up next, The Close. Stay tuned.